Imagine you run a bakery, a really popular one. Customers are lining up for your famous croissants. But then, disaster strikes. You run out of flour. The baker shouts, "We're out!" The cashier at the front has no idea. Your supplier sent the wrong kind of butter last week. You have no record of who approved it. Someone paid an invoice for sugar that never even arrived. This is chaos. It's a mess of sticky notes, frantic phone calls, lost money. This is a business without a system. This business is bleeding efficiency and profits, because simple things like knowing how much flour you have are left to chance and guesswork. SAP is software that helps big companies manage all their business processes in one place. It connects everything, from the money guys in accounting to the people packing boxes in the warehouse. It's like the central nervous system for a business. Instead of a dozen different apps and spreadsheets that don't talk to each other, SAP provides one source of truth. It's the ultimate organizer, making sure everyone is reading from the same script. So, where does our bakery problem fit in? We need to manage our stuff. Ingredients, packaging, cleaning supplies. This is where SAP MM comes in. SAP MM, Materials Management, manages a company's purchasing and inventory. It handles buying the raw materials, storing them in the warehouse, paying the supplier. It's the digital quartermaster for your entire business, ensuring you have what you need when you need it, at the right price. This isn't just about avoiding stockouts. It's about building a rock-solid, efficient, and predictable supply chain. Why does this matter? Because your supply chain is the backbone of your business. If you can't get the right materials, you can't make your product. If you can't make your product, you can't sell it. If you can't sell it, you don't have a business. SAP MM brings discipline to this critical process. It automates the tedious work, provides crystal clear visibility into your stock, helps you build strong relationships with reliable suppliers. It transforms purchasing from a reactive panic into a strategic advantage, saving time, cutting down on waste, making your business stronger and more profitable. It stops the chaos before it even starts. SAP MM helps organizations manage the materials, inventory, and procurement activities effectively. From identifying a need for materials to procuring, receiving, and managing stock levels, SAP MM covers it all. Example, imagine running a bakery. You need ingredients like flour, sugar, and eggs. SAP MM is the smart system that helps you know when you're running low on flour, place an order to your supplier, track when the delivery arrives, update your pantry stock, pay the supplier after verifying the bill. Before you can bake a single croissant, you need a recipe. That recipe has a list of ingredients, instructions, details. In SAP MM, this is called master data. It's the core information that the system needs to function. It's the permanent data that doesn't change every day, and it serves as the foundation for every single transaction. Think of it as your company's digital cookbook and your contact list. Without good master data, the whole system falls apart. It's the boring, behind-the-scenes work that makes all the exciting stuff possible. Getting this right is non-negotiable. It's the difference between a smooth operation and a system full of errors. First up, material master data. The detailed record for every single item you buy, store, or sell. It's not just a name, it's a complete profile. Example, organic all-purpose flour. Unique material number, unit, kilograms, storage location, pantry shelf A1, who is responsible for buying it, how we value it. The single source of truth for every ingredient. When someone needs info about that flour, they check this one record. Ensures consistency across the company. Buyer, warehouse clerk, accountant. Next, vendor master data, your digital Rolodex of suppliers. It contains essential vendor information. Example, Golden Grain Farms. Address, contact information, payment terms, net 30, bank details. To keep a growing business from turning into a chaotic mess, you need structure. You need to define who is responsible for what and where everything happens. In SAP, this is called the organizational structure. It's a hierarchy that represents the legal and logistical layout of your company. Think of it as the blueprint for your entire business empire. For our bakery, let's imagine it's growing from one small shop into a chain of cafes. This structure lets SAP manage centrally while handling unique needs. At the very top is the client, the highest level in SAP. It represents the entire corporate group, Casey's Croissants, Inc., the big umbrella covering the whole business. All data for all operations is held in this single client. Below that, company code, a legal entity for financial statements. USA and Canada would be separate codes. We'll use Casey's Croissants USA. Physical locations next. Plant, operational unit, factory, distribution center, individual bakery cafe. Soho Cafe is one plant. Brooklyn Cafe is another, place where production and services happen. Within each plant, storage locations, specific inventory places. Cold storage, butter and milk. Dry pantry, flour and sugar. So we know not just that we have flour, but exactly where it is. Purchasing side. The purchasing organization negotiates with vendors, centralized for the company. One per company code, or per plant. We'll use one central USA purchasing org for bulk pricing. Purchasing groups are the buyers. Individuals or small teams doing daily purchases. Food ingredients. Group buys flour and sugar. Packaging group buys cups and bags. This structure creates clear lines of responsibility. Now that we have our data and our structure set up, how do we actually buy something? This is handled by a core process in SAP MM called the procure-to-pay, P2P cycle. It's a logical sequence of steps from identifying a need to paying the supplier for the goods. It's documented, it's traceable, it's controlled, ensuring every purchase is deliberate, approved, and properly accounted for. This isn't just ordering stuff, it's a strategic workflow that brings order and accountability to spending money. Every step creates a digital document in SAP, leaving a perfect audit trail. The cycle kicks off with a purchase requisition PR. This is an internal document, a formal request that says, "Hey, we need something." It doesn't go to a supplier, it alerts the purchasing department. For our bakery, a baker sees the flour bin is getting low and creates a PR in SAP for 100 kilograms of flour. The next step is the request for quotation, RFQ. If we don't have a set supplier or want to check prices, the purchasing department sends an RFQ to several vendors asking for a price and asking for a delivery date. Once the suppliers respond with their prices, we do a quotation comparison. Our buyer sees that Golden Grain Farms has the best price and can deliver tomorrow, so they are selected. This leads to the purchase order, PO. This is the official, legally binding document sent to the vendor. It says, "We officially want to buy this item at this price, delivered by this date." Our buyer creates a PO for 100 kilograms of flour and sends it to Golden Grain Farms. The supplier delivers the flour. Section 5. Managing the pantry. Inventory Management 101. Having the right stuff is only half the battle. You also have to manage it properly. This is inventory management, a huge part of SAP MM. It's not just about counting what you have, knowing its status, where it is, and tracking every single movement it makes. Think of your warehouse or storeroom as a library. Inventory management is the librarian who knows where every book is, who has checked one out, and which ones are brand new and still wrapped in plastic. It gives you total control over your physical stock, which is one of your company's biggest assets. First, let's talk about stock types. This tells you the usability of your inventory. The most common type is unrestricted use stock, the good stuff, ready to be used immediately. In our bakery pantry, this is the flour on the shelf that's open and ready for the bakers to grab. Then there's quality inspection stock. Inventory that has arrived but needs to be checked before it can be used. Imagine a new shipment of expensive vanilla beans arrives. They go into this stock until inspected. Finally, there's blocked stock, physically in the warehouse but not to be used, maybe damaged or wrong item. A bag of flour that ripped open during delivery would be put in blocked stock. To track how stock moves between these types and locations, SAP uses movement types. These are 3-digit codes that identify the type of inventory movement taking place. It's like a specific reason code for every change in your inventory. For example, when we receive flour from a supplier, we use movement type 101, goods receipt. This tells the system to increase our inventory. If a baker takes flour from the pantry to use in the kitchen, that might be movement type 201, goods issue for a cost center. If we find a damaged bag and move it to blocked stock, that's another movement type. Every single transaction is recorded, giving you a perfect history of every item. So, we have all this stuff in our pantry. Flour, sugar, eggs. How much is it all worth? This is a critical question for accounting. SAP handles it through a process called material valuation. This process determines the dollar value of your inventory, which is essential for your company's balance sheet. It's not as simple as just looking at the last price you paid. The price of things changes, and you need a consistent method to account for this. SAP primarily uses two methods for this: standard price, moving average price. Choosing the right one depends on your business and the type of material. The first method is standard price. With this method, you set a fixed price for a material for a specific period, like a quarter or a year. All inventory movements for that material are then valued at this standard price. Let's say we set the standard price for one egg at 30 cents. It doesn't matter if we buy a batch for 28 cents or another for 32 cents. In the system, every egg is valued at exactly 30 cents. If there's a difference between the standard price and the actual purchase price, that difference is posted to a special price variance account. This method is great for stability and simple cost control, especially for things you manufacture yourself, as it keeps the value consistent. The second method is moving average price. This method is more dynamic. The price of the material is recalculated every time you receive new stock. The system calculates a new average price based on the total value of the existing stock and the value of the new stock. Let's go back to our eggs. Imagine we have 100 eggs in stock that we bought for 30 cents each, total value $30. Then we buy 100 more, but this time the price has gone up to 40 cents each, total value $40. $30 plus $40 divided by 100 plus 100 eggs equals $70 divided by 200 eggs equals 35 cents per egg. This method reflects the current market prices more accurately and is often used for raw materials or traded goods whose prices fluctuate. Choosing between standard price and moving average price is a key business decision. Standard price provides cost stability and makes it easy to spot variances, which is why it's often preferred for finished goods. You set the cost and then measure your production efficiency against that standard. Moving average price, on the other hand, provides a more realistic, up-to-date valuation of your raw materials, which is crucial for accurate financial reporting when commodity prices are volatile. SAP allows you to choose the right method for each material, giving you the flexibility to manage your inventory valuation in a way that makes the most sense for your business. The procure-to-pay cycle is a beautiful thing, but its real power comes from its checks and balances. The most important of these is invoice verification, which is where everything gets tied together. The core of this step is the famous three-way match. This is an automated process where the system checks 3 key documents to make sure they all agree before it allows you to pay a supplier. It's the system's way of asking, did we order this? Did we receive it? Does the bill match what we ordered and received? This simple automated check prevents overpayment, fraudulent invoices, paying for goods that never showed up. It's a financial safety net for your company. The 3 documents in the match are purchase order, goods receipt, invoice. First, the system looks at the purchase order. What did we agree to buy and at what price? For our bakery, this was the PO for 100 kilograms of flour at $1.50 per kilogram. Second, it looks at the goods receipt. What did we actually receive? Our clerk recorded the receipt of 100 kilograms of flour. Third, it looks at the supplier's invoice. What are they billing us for? If the invoice is for 100 kilograms of flour at $1.50 per kilogram, all three documents match perfectly. The invoice is approved for payment automatically. It's clean, fast, and requires no human intervention. But what happens if they don't match? This is where the system flags a problem. Let's say the supplier's invoice arrives, but it's for 110 kilograms of flour. The system will see a quantity mismatch between the PO, goods receipt, invoice. It will block the invoice for payment and alert the accounts payable team to investigate. Or maybe the price is wrong. The invoice says $1.60 per kilogram instead of the $1.50 on the PO. Again, the system will block it. This forces a human to look into the discrepancy and resolve it with the supplier before any money is sent out the door. It's a crucial control point. This process highlights the incredible power of integration. SAP MM doesn't work in a vacuum. It's deeply connected to other SAP modules. When an invoice is verified, MM talks to the finance module to post the costs and schedule the payment. When you buy raw materials, it connects with production planning to let them know the ingredients are available for baking. When you sell a croissant, the sales and distribution module might trigger a need in MM for more ingredients. And when goods arrive, it can trigger a check in the quality management module. This seamless integration ensures that data flows in real time across the entire organization, with every department working from the same, up-to-the-minute information. Theory is great. Let's make this real. Imagine we are using our success to open a brand new location, the Brooklyn Cafe. How would we use SAP MM to get this done smoothly? It's not just one action, it's a sequence of logical steps to prepare the new location for business. This is where all the pieces we've discussed come together. Organizational units, master data, purchasing processes. Following these steps in order ensures nothing is missed and the new cafe is ready from day one. First, set up the new location in the system blueprint. Create the new organizational units. Define the Brooklyn Cafe as a new plant in SAP. Within that plant, create storage locations, BK Dry Pantry, BK Cold Store. Extend our existing purchasing organization, purchasing groups, so we can buy for this plant. This setup tells SAP the new physical location is part of our company. Next, populate the cafe with master data. Decide which materials, ingredients, cups, napkins. Extend material master records for standard items to the Brooklyn plant. This makes them available for purchasing and inventory at that location. Set up our suppliers. Extend vendor master records for key suppliers like Golden Grain Farms. Create purchasing info records if special pricing or delivery sources exist for Brooklyn. With structure and data in place, stock the pantry. This is where procure to pay begins. Manager creates purchase requisitions for initial stock. Flour, sugar, butter, coffee beans, cups, everything else. Purchasing converts requisitions into purchase orders and sends them to suppliers. Trucks arrive at the Brooklyn Cafe. Staff perform goods receipts in SAP for each delivery. Inventory levels update in the system. The system is now live with real stock. Finally, keep an eye on things. Manager relies on key SAP reports. Run MB52, warehouse stock. Use ME80FN, general purchasing evaluation. Use ME6H, vendor evaluation. These reports provide the visibility needed to prevent chaos and manage the new cafe effectively. So, what's the big takeaway here? We started with the chaos of a bakery running out of flour, a simple problem that can cripple a business. We saw how sticky notes and panicked phone calls are a recipe for disaster. SAP MM is the antidote to that chaos. It's the system that transforms your messy, reactive supply chain into a clean, organized, and efficient operation. It takes the guesswork out of buying and managing your materials, giving you a level of control that's impossible to achieve with spreadsheets and manual processes. It lets you run your business like a Michelin-starred kitchen, where every ingredient is accounted for and every step is executed with precision. The core benefit is order. By creating a rigid structure with master data, organizational units, and defined processes like procure-to-pay, SAP forces discipline. It ensures that every purchase is intentional, approved, and tracked. You always know what you have, where it is, how much it's worth, and when you need to order more. This visibility is power. It allows you to make smarter decisions, negotiate better prices with suppliers, reduce waste from expired or damaged stock, and ensure you never have to tell a customer, "Sorry, we're out." Ultimately, the magic of SAP and SAP as a whole is its integration. The purchasing department, the warehouse, the finance team, and the production floor are all working with the exact same real-time data. A game changer. An order placed by a buyer instantly informs the financial forecast. A goods receipt in the warehouse immediately makes those materials available for the production team. This single source of truth eliminates confusion, reduces errors, and makes the entire business faster and more agile. It stops the chaos and, lets you focus on what you do best, baking amazing croissants.